So again, I'm very happy to be asked to present at this forum. I'm taking a bit of a different tack in the sense that I want to not just dive into our investment approach, but talk about a broader topic that has always been a big fascination to me. And, you know, that's our title here, Staying Safe and Profiting from the Delusions of the Masses. Because investor behavior, human emotions generally, can really cause people to make bad investment decisions. And so I think, well, first of all, I find this a very interesting topic. Hopefully you'll all find something of interest out of this. And I think it can also be useful both to, I like to share this with individual investors and with advisors in terms of giving, you know, perhaps some lights might go off, bells in your head about how, you know, some of your own experiences, both with the markets and with clients, sort of were affected by these various kind of psychological characteristics that all people share. So I'd like to start off with this quote. Sir Isaac Newton, this is his quote: "I can calculate the movement of stars, but not the madness of men." And we're all familiar with Isaac Newton, and, you know, one of the fathers of astronomy and you know, the theory of gravity and all that stuff. And but what's interesting is the context of this quote. And we're going back to the 1700s. And as smart as the guy was, he personally lost a lot of money in a speculative bubble at the time that was known as the South Sea bubble. There was a company, the South Sea Company, that kind of like the old the tulip bulb craze in Holland. This company, the speculative frenzy got behind its share price, and a lot of people got caught up in it. And then when the bubble burst, they lost a ton of money. And I titled this slide in the context of this quote, "The Constancy of Irrationality," because, you know, portfolio theory, modern portfolio theory would tell you that, you know, in these days, given the preponderance of more transparency and information and regulation and all that kind of stuff, that people would be less irrational, but they're not. And it's really because of the way the human mind is and human psychology is structured. So again, I mentioned earlier that this is a topic I enjoy talking about, and it really, you know, it's sort of it's part of a personal narrative in my own life, kind of a journey from theory versus reality. And you know, as Eris mentioned, you know, I studied finance at a graduate level. I also have my CFA. So I've studied investment theory and investment and market theory in a very formal way. And there's actually quite a disconnect between the theory and then what you see in the real world. And I find it really interesting. It's when I kind of had that epiphany moment many years ago. I found that so compelling that was sort of the catalyst for me to make a career shift from the corporate finance side of things into buy-side investing and investment research, because I saw the opportunities that can exist when one is aware of market psychology and doesn't fall prey to its downsides. So, you know, in the long term, for sure, markets are pretty efficient. They're, you know, in developed markets are quite robust, and they can be trusted. But in the short term, they're not efficient at all over many short-term periods. And the reason is simply human psychology. So again, the theory versus reality. This is just a hypothetical few lines thrown together. If you took a public company, a private company, and you owned it, and for whatever reason, once a year, you brought in the valuators to value your private company. And let's say it's a company that kind of is doing the right things and it's growing intrinsic shareholder value, the kind of stuff we look for that I'll talk about later in the presentation. And so you took that annual valuation and you plotted it out, and it might look something like that dark line, right? Kind of a gradual growth, not a lot of volatility, kind of year to year. Now, you could take that exact same company and list it as a public company, and now it's got a share price trading in the markets. And the market price is a long-term graph of that is probably going to look more like the squiggly line going up and down, whereas the market price is often divorced from the intrinsic value. Sometimes the market price of a company is too expensive. Sometimes it's overly cheap. And again, so this is what we're talking about, and it's kind of the human factors that cause the market price to get ahead of the intrinsic value. It's also human factors in market psychology that cause the market price to get to below intrinsic value. So the great motivators. So the two big motivators we always hear about are fear and greed. And it's absolutely true that it affects everyone in all areas of our lives. And in some areas where it's less important, we're less cognizant of it. In the area of investing, I think it's very important to be very cognizant of these motivators. Sorry. So the fear of losing is an obvious one, right? And one way we've seen it in the investment industry, whether as portfolio managers or as advisors, is the fear of losing, and that in the best case scenario that might cause people to be too cautious with their money, but it can also cause a lot of permanent losses for clients when in periods of down markets. So someone's holding a portfolio of perfectly good stocks, the markets are down 20%, they're afraid of losing more. So rather than holding with the investments that make sense and are actually now more attractive because the market prices are down, for the fear of kind of losing their capital permanently, people dive out of the markets at the wrong time. But then there's also what I think is even more powerful fear, is the fear of missing out, the fear of falling behind. And I actually think it ties in with the greed motivation. I've come to believe that greed is actually a manifestation of fear. Human greed is really the fear, again, of falling out, of missing behind, of missing out, falling behind, of not having as much as your buddies or your next door neighbor. And it's this fear, we've been hearing it a lot, certainly with stocks like Tesla and the whole GameStop thing and Bitcoin, FOMO, FOMO, the fear of missing out. That is a very powerful motivator that causes people to make some very bad investment decisions. And then also on the greed side, the obvious ones are also, the people looking for fast returns. Again, Bitcoin, Tesla, GameStop, those kind of dynamics. And, a general vulnerability to glamour stocks. And I'm going to define what I mean by that. But generally, we're talking about stocks that maybe they have weak fundamentals, or maybe they're decent fundamentals, but there's a real speculative flurry behind them. And everyone wants to own them regardless of the fundamentals or the valuation. Okay, so here's another human trait, and that's short-term focus. And when it comes to the investment world, this is a big one. This is one of the biggest issues, and this also provides one of the biggest opportunities, in that if you can take a long-term focus in financial markets where generally the crowd mentality is short-term focused, that's where opportunities exist, and it's this short-term focus that also results in a lot of bad investment decisions being made. So there's a psychological phenomenon called the recency bias, Basically, people have a tendency to take the most recent short-term data set and extrapolate that forward. And again, so we see this in a lot of areas. I think, even right now in the housing market, obviously, the low interest rate environment is driving up housing prices. But I think there's also, there's a demand also tied in with the fear of missing out, in that people are saying, wow, look, if you own a house, it's going to increase by 10% a year over the last 5 years or whatever. So let's get in, because that's what it's going to be going forward. And we know that's rarely the case. When it comes to the investment industry, the short-term focus causes managers to be compared against short-term benchmarks, and that results in a lot of ineffective money management going on everywhere. And I'll talk about that a bit more. It's a short-term focus, again, with the recency bias, and combined with that and the fear of missing out, that causes investors to chase returns, and that return chasing can result in some very bad results. So here's a great example. I pulled this one out years ago. So this data set itself is a bit older, but as I said, things don't really change that much. So I think it's still applicable. So at one point, this was from an academic study where they basically picked this out of the US. They picked the mutual fund, equity mutual fund, that had the best 10-year return. It happened to be this GGM Focus Fund. Its 10-year average annualized return was 18%. But then what they did in the study, because it was a unit trust mutual fund, the academics had all the data of money flowing into the fund and flowing out of the fund. And from that, they were able to deduce that even though this fund on an average annual basis had returned 18%, the average investor in that fund over that 10-year period probably lost around 11%. And that is because, again, because it was a fund that, being an equity fund, that 18% wasn't even. I'm sure there were years where it was 30, 40%, and there were years where it was negative. And this was a really good illustration of people stampeding into a fund after it had a very high short-term return, like a one-year return of, again, well beyond 18%. And then investors stampeding out of the fund in a period where it had less than stellar returns, whether on an absolute or a relative basis. Other psychological factors that factor into investment decisions, action bias. So, again, when people, and when I say people, I'm talking individual investors or even professional portfolio managers, there's a propensity that one has to be doing something. One has to be making decisions, trading. It leads to a lot of unnecessary trading just for people. They feel they need to be doing something. It's hard to say, we're going to take a long-term return, have a low turnover. When it comes to individual investors, the action bias, or there's actually a physiological factor in that when people make bets, whether it's at the racetrack or on a stock on their phone and through one of these apps or Robinhood or whatever, there's actually an endorphin rush that comes with it. Whether they end up winning or not, just the act of making the bet or making the trade provides some physiological effects that cause people to do these things. The story effect is interesting, and I think we all know what we're talking about here. Rather, if there's an exciting story behind something, the cannabis stocks, et cetera, Tesla obviously is a good example. Oftentimes investors will rush to that stock regardless of the fundamentals, regardless of the valuation. And the herd mentality is interesting too, because people find comfort in social validation. And that social validation can be in a lot of things, how you dress or whatever. But one of them is in investments. So if all of your buddies and neighbors are buying Tesla, so you buy it too, well, there's sort of a feeling that comes with safety in numbers, and there's a social validation in that. And again, there's just this emotional bias towards making those kind of investments for that reason, which is the wrong reason, of course. So what does this mean to all of us? So all of these factors work their way into the portfolio management industry and cause issues. So basically, you have the pressures coming from the general public and their behaviors, and the pressures work their way, through the advisory channel and to the large fund companies and the institutional management companies, et cetera, et cetera. And I believe as a result, the investment industry generally has too much of a focus on their own business risk as opposed to client risk. And when you have very large companies and especially public companies that are answerable to short-term earnings and that sort of thing, they're very hesitant to sacrifice short-term revenue growth. So oftentimes it's better to, it's safer from their own business perspective to kind of go with the herd and do what everyone else is doing, and as opposed to doing kind of what makes sense that might not be popular at a given time. Again, and this is subject to that whole short-term pressure thing. Again, that short-term pressure imposes itself onto the investment management industry. I'm of the belief that, and from what I've seen, that it's the emphasis on short-term results overrides effective risk management. The story I always like to share, and because this goes back many years, as I said, I was in a different area of finance when I started learning about these philosophies, the whole idea of value investing and patient investing, contrarian investing, and I was very lucky at that time when I wanted to pursue that route. I was able to get a position with the large fund company, with a group that to a very large degree did practice that kind of investing. And it was interesting because when I started in this industry, one of the things that was nagging me was that this whole philosophy we're talking about, it makes so much sense. But if it makes so much sense to me, then it's no secret what we do. So why wouldn't it make sense to everyone? And if it made sense to everyone, then these opportunities that we look for, basically trying to find well-priced opportunities, and I'll talk about that more, and avoiding the overpriced stuff, like why would those anomalies exist? And that was, I'm still coming from the perspective of, financial theory. And I got my answer very quickly. When I was down in the US, I was at an investment conference put on by one of the big brokerage firms, and we were in New York. And I'm in this big conference room, and I'm kind of new to this world. And over one of the coffee breaks, I find myself in conversation with a few other analysts / portfolio managers from different kinds of firms. And the one guy in this group, it was a small group of 4 or 5 of us, was truly a veteran, a person who was the head of the asset management arm of a major firm. And so to me, this is someone who's been around the block, and he's on top of his game a whole bit. And we were talking about one company that had caught my eye during the presentations, and that it seemed to be a good company for all the reasons I like. And its stock price had been beaten up for what seemed to be the wrong reasons. And the conversation turned to that company, and my 2 cents were, well, this seems like a really good opportunity to buy this company at a very good price. And I'll never forget this. It's so ingrained in my mind when the guy looked at me and he said, well, I agree with your points, but it could take more than a year for the price to come around. And I kind of, puzzled reaction I had was betrayed by my face, I suppose. And the guy looked at me and he said, he caught it. And he said, do you mean to say you could buy stock if you thought it would take more than a year for the price to come around? And I said, yeah. And he just looked at me and said, well, that's amazing. So that was a big epiphany. Like, he understands it, but where he works and all these institutional imperatives prevent him from taking a long-term outlook, even though that's what ultimately makes sense for the clients. Just quickly on over diversification, we've talked about that. We're also big believers in concentration. The whole idea of diversification is really there as a protection more for the firms. Again, like I said, their own business risk as opposed to client risk. Really, it's about closet indexing and not wanting to deviate too much from one's benchmark quarter by quarter. If you really want to be a good long-term investor and have good long-term results, you have to be willing to do that. But again, that's rare to find in the investment industry. And in fact, I would argue that over diversification not only does not bring the risk mitigation that it's purportedly there for, but in fact, it starts increasing risk, because I'm going to describe to you in a couple of slides what we look for in terms of the qualitative side and the valuation side of companies. And I can tell you at any given time, there are not 100 or 200 of those opportunities available. And, just quickly, we avoid companies with a lot of debt or with low inherent profitabilities and things like that, bad management. If you own the index or closet own the index, you own all those terrible companies and terrible opportunities. And why would you? But that's what happens. In any event, so that's all the bad news. And so what's the solution? So, sorry, another slide here. So yeah, so ultimately the problem here is all the stuff I just talked about. And human nature causes inadequate investment solutions out there, lack of effective managed money offerings. Not to say that they're not out there, but they're not pervasive. And so what do we do? So I call our approach fundamental value investing. Now, there's different kinds of, value investing means a lot of things. It's not enough to say value investing. There's relative value approaches, absolute value approaches. We're definitely in the absolute value approach. I don't care if something looks well priced compared to something else. I want something that's well priced compared to what I think its intrinsic value is. But then even in the world of absolute value, there's different categories. There's more of a, let's call it deep value, where you're looking at special situations or companies that are actually kind of cigar butt lousy companies, but if they're worth 50 cents a share, you can buy at 10 cents a share. You buy a bunch of those and take your chances. That's not what we're about. But so I'll talk a bit more about sort of the qualitative and quantitative criteria we look at. The long story, and I am watching my clock. I don't want to run out of time, so I'll be quick. So long story short, our perspective is we're not investing in markets. We're using markets to buy pieces of companies. We're looking to buy the right companies at the right price. Protection of capital is a paramount consideration for us. It's growing clients' capital and protecting clients' capital for us are equal objectives, and we're very, very focused on risk management. Okay, so long story short, again, it's similar to the chart I showed earlier. Actually, I think we already talked about this one. So oh no, I didn't. This one here, we're showing kind of a similar company and trying to depict kind of visually what a glamour stock is versus a value stock. A glamour stock is a company that has gotten a lot of there's a lot of excitement, buzz about it, and that has sort of fed the market to push that stock up into an unreasonably high price. Could be a great company, too expensive, we don't want to own it. We're looking to buy kind of at that blue line or enough below to give us sufficient margin of safety in every investment. And that margin of safety is really dependent on the nature of the company and the kind of industry it's in. So long story short, we take the the entire universe of stocks, and then we really screen down to zero in on what we think are at any given time are good opportunities. We reject overpriced stocks. We're really looking for strong balance sheet. We get more into esoteric analysis of the business prospects and the management. And then we dig even deeper and we get into, okay, bottom line earnings aren't enough. They don't tell the whole story. We dig deeper into the cash flow picture. Can we understand it? And profitability is key because we're big believers in that we don't create the wealth for clients. Our job is to zero in and find those companies that are creating wealth for clients and make sure we buy them at the right price and only continue holding on to them if the price continues to be reasonable and not overly expensive. And but what is a company that's creating intrinsic value? We really focus in on that. It's got to have an appropriate return on equity, and again, that's on a free cash flow basis. The GAAP earnings aren't good enough, and ultimately, we're looking for strong companies, favorable prospects that we think are available at an advantageous price. Now, the other thing about this is where kind of differentiates us to a degree is our level of, again, risk management and patience. And patience not just in buying the right companies and then being patient with holding them, but also if we sell something because it got too expensive, and then we have some cash and we can't find anything to buy, we're also one of the few managers that are willing to let meaningful levels of cash build up in our portfolios until the right opportunities present themselves. And again, you don't find that a lot in the industry because obviously if you have a fair bit of cash, that's going to be a drag on your short-term results. But to us, that's okay because we take the long-term view and try our best to ignore the short-term. Again, as an independent firm, there's various advantages, but I think the biggest one is the fact that we are not subject to short-term pressures. I'm not built that way, and we don't have an overlying structure telling us that you should buy this stock, or lower your cash, et cetera, because we're afraid you're going to lag this quarter, and we want to do something about that. That's probably our biggest competitive advantage. And so, again, big picture, we've had very strong results as compared to our benchmark. But just as importantly, we've done it with far lower downside volatility. I mean, if you look at the history and comparing the drawdown of our equity portfolio with that of the benchmark, you can see that in periods where the markets have gone down significantly, we have not gone down nearly as much. Case in point, Q1 of last year, where our benchmark, and by the way, our benchmark is a combination of the MSCI World and the TSX, because we put in one portfolio, we blend global with Canadian. So, last year in that first quarter, our benchmark was down, when our benchmark was down 17.7%, our total equity portfolio was only down 8.5%. These are a couple of quotes that really kind of flow through everyone's veins here, and that's rule number one. This is Ben Graham's quote. Rule number one, don't lose money. Rule number two, don't forget rule number one. And then this quote of Warren Buffett, which I love: be fearful when others are greedy, be greedy when others are fearful. Right now, we think people are kind of on the greedy side, so we're kind of on the fearful side. So that's all I've got.